All right, so I think we're live.
I think we are.
I think we're live, Ida. So welcome everybody to this UFile Facebook Live session. So I'll introduce myself. My name is Jerry Vitratos, and I'll introduce as well Ida Celli over here. And we are here to answer all your tax-related questions. So don't hesitate to ask away. I'll also present to you Emmy Valme, who's our producer/director, who you cannot see right now, but she's the one who's flicking all the knobs right now for this session. All right, so go ahead, everybody. Do not hesitate. Go ahead and ask away any questions you guys might have.
All right. Why don't we start off with, we have listeners here. Every year they do their taxes. What advice would you give them, or a checklist for them to be able to go ahead and get ready for tax season and not forget a slip, or how to remember, or a procedure of how to go ahead and do their tax return? Okay,
so what I would say is, like with anything else when it comes to tax return, my best advice to everybody is to get organized. Okay, that's really the first piece of advice I would give to anybody, is simply get organized. Okay, get your documents organized in a proper pile. All right. So a little while ago, we actually, we wrote an article for the Canadian Personal Finance blog, which is a really great website for personal finance, where we gave a New Year tax checklist. And within that checklist, the advice that we gave, I was a guest writer for that website, and the advice that I gave was essentially, when it comes to your tax documents, what I would do is I would create 3 separate piles when it comes to organizing your documents. So the first pile would be all your income slips. So all the income slips that you have during the year, put them all in one specific pile. Okay? So that's what I would do as a first step. As a second step, I will grab all the expense receipts that you have, but specifically related to deductions on your tax return. Okay? So for example, I would talk about, RSP receipts. Okay? I would talk about, let's say, union or professional dues. Childcare expenses is another example. Moving expenses. So all these receipts should be grouped up into another pile. Okay? Your third pile become, again, your expenses, but dealing with credits in this case. So credits meaning donations, okay, medical expenses, tuition receipts, etc., etc., etc. So these are the 3 piles that I would create, okay, to organize your documents to get ready for the production of your tax return. The reason why I say these 3 piles and in that order that I mentioned is because that's the order you will input this information on your tax return. And consequently, you would also input this in the software in UFile in that order as well. You would start with your income slips, then go to your expense receipts that are related to your deductions, and then finally, you would go into your credits. Okay, and that's why I would organize it in that way.
All right. We do have a question from, let's see. She says, my partner is self-employed for the first time this year. Will UFile automatically calculate the CPP he needs to remit?
Yes. So the answer to that question is yes, absolutely. The moment you input your self-employment income, in this case, UFile will automatically compute, in this case, your CPP payable as a self-employed individual. Okay, so there's no special entry that needs to be done in the software. You simply plug in your income and expenses in the specific area, which would be self-employment income. That's where you would enter it, and UFile will compute it automatically.
Okay, we also have a question from Tainan Lu. She's confused about tuitions on the tax return. Okay. How can I get the money? I only see options of carry forward and transfer to others. So first of all, tuitions is not a refundable credit.
No, it's a non-refundable credit, right? Like I mentioned in the tax checklist, right, at the first portion of the session was, these are related to credits, right? So these are non-refundable tax credits that you input, okay? And these would be, essentially, they're used to reduce your federal tax, but nothing more. You can't go beyond your federal tax with those credits. So in other words, you can't refund yourself on any tuition receipts that you have that are in excess of your federal tax. Okay, you can't go beyond that. Okay, that's number one. Number two, within the UFile section, no, you should be able to have, you should have that section there where you can input your receipts for the current year. It's in the same section as where your carry forwards are. You simply have to go to the top of the section, and what's going to happen is that UFile is going to ask you for the number of months that you were full-time or part-time, and next to that, you enter your amounts. UFile will also give you a dialog box where you enter your educational institution. In other words, whatever university you went to, and then you simply enter your cost. Okay, it's in the same page in the same area.
If you have tuition fees carry forward, where would you find that information?
So tuition fee carry forwards, well, first of all, UFile in and of itself, the program, if you've been using UFile for several years, UFile will carry forward that amount automatically for you. So our program actually tracks these amounts for you from one year to the next. Now, assume this is your first year with UFile, in this case, then what you would do in that case is you would go to your notice of assessment. So I know some of you might not know what a notice of assessment is. I'll give you a clue. It's the document that your refund check is attached to. Okay, so I'm going to give you guys that clue. I keep getting that all the time. What's my notice of assessment? Where did you get your money? Oh, that document. Yes, that one. Guys, that is a holy document when it comes to taxation, all right? It has a lot of amounts in there that are carried forward that you can bank, quote unquote. That's not the official term that you could use for that, but you can bank these amounts and you can use them to reduce your tax in future years. So your notice of assessment will tell you whether you have any tuition carry forwards. That's number one. Number two, you can go also to the My Account portal on the CRA website. That's another place you can go and get your carry forward amount. Okay, so you simply create an account with the CRA. It's very, very easily done because you can use the same login credentials as your bank account with your financial institution. The CRA has what they call the partner sign-in. So you simply log in like you do with your bank and you go into the CRA website and all your carry forwards are there. So simply go ahead and do a search of My Account CRA and start the process and create your account.
Okay, we have a question from Melinda Timmins. She works from home in Ontario.
Okay.
And her employer is in BC.
Okay.
I meet with clients only via phone and from my phone.
Okay.
Do I qualify to claim expenses as a work from home employee? I saw something on the CRA site about having to meet clients in my home to qualify. Okay,
so first things first, I just want to confirm, is she an employee or self-employed? That's the first thing I want to confirm. So I work from home. Okay, so let's do both. Okay, so I see employer, which means employee. The answer is yes, so in theory. Okay, what you can do in that scenario is that your employer has to produce a specific form called the T2200. Okay, so that's the conditions of employment. Okay, it's a specific form that allows you to deduct your home office expenses as an employee. Okay, now the purpose of this is that your employer has to sign off on the fact that you have to incur expenses out of pocket in order to what's called work for the company. Okay, so but you require this specific form, which is the T2200, signed by your employer that stipulates to the CRA that you do incur these expenses out of pocket. The moment you've got that form, then yes, absolutely, you are allowed to deduct home office expenses. Again, remember though, home office expenses are prorated expenses, which means that you have to take the portion of your home that you use entirely for your employment, and you could only deduct the percentage of that space. You have to prorate, in this case, your expenses based on the percentage of the space of your home that you're using for that office. Example, my home office is about 10% of the space of my property, of my home. That means that my home office expenses, whatever expenses I'm allowed, I can only deduct 10% of those expenses. Okay, that's what I would be allowed. But first things first, contact your employer and get that form, T2200, conditions of employment. Okay, you have to get that filled in and signed by your employer. Once you have that, now you can deduct your expenses, and you deduct them through a specific form, which is the T777. Okay, so it's the T777, employment expenses. Within UFile, you simply go into the employment section in the interview setup and choose employment expenses. You tick that box and UFile will produce that entry for you to produce the form.
Okay, we have Sina Fu who says, sorry if I mispronounce your names, guys. If you made a mistake when you filed.
Yes.
Okay, can you go ahead and correct your return after it's been e-filed?
Okay, so if you've made a mistake on a file that's already been assessed by the government, then yes, this is what we call an adjustment. So the government allows you to produce an adjustment on your return. You do this by getting a specific form, which UFile produces as well, which is the T1ADJ, okay, ADJ, or for adjustment. You could use the software to do this as well. We have a section within UFile in the interview setup to do this. Or you can simply go to the CRA website and look up the form, T180J. And on that form, you'll simply list the line number that you want to change. So you list whatever that line number is. You're going to enter whatever the old amount was that you first submitted to the CRA, and then you input the new amount, the adjusted amount that you want to adjust with the CRA. This form is normally a mailable form. You print off the form and you submit it to the CRA. That's one way. Another way is, again, as I mentioned before, with the notice of assessment and the tuition carry forward, you could also go to My Account. You could also go to the My Account portal and you can submit, you can actually submit your adjustment electronically directly through the portal. Now, there's a caveat to that. There's a little thing that I want to make sure that I specify. Not every adjustment can be done through the online portal. Okay, so you have to be careful. You're gonna have to check in My Account to see whether you can adjust it there, but it is doable. So the answer is yes, you can through those two procedures.
Okay, we have Shirley Gibson. I am an individual, a senior. I have used UFile, but in 2018, I bought a condo which I rent, so I hired my taxes. She hired somebody to do her taxes. Okay. Hold on a second, and she found it was expensive. So I'm wondering this: does UFile have the capability for me to do my rental income and expenses?
Yes, the answer is yes, absolutely, with no extra charges, by the way. We don't have any special versions for businesses or rentals or anything like that. When you purchase UFile, whether it's the online product or whether you are buying the Windows version, you could buy this at Best Buy or Staples or Walmart. Okay, it comes included with the rental statement as well. So you can do self-employment, you can do rental statements, you can do employment expenses, which I mentioned before in the previous question. All these come included with a purchase price, regardless of the version of UFile that you buy. Whether it's UFile 4 or UFile 12, it comes included. So absolutely, you can do that. It is supported by our product.
Okay, now we have a question from Lori Olson. Hi, Lori.
Hello. Hi, Lori.
I'm confused about deductions for taking care of a senior. My 9-year-old mother-in-law lives with her son. Can he deduct any expenses he has incurred to make his home suitable for her? He has installed ramps and a walker in the shower.
Yes, so the answer is yes. Okay, so there is a non-refundable tax credit on the federal return that allows you to claim the renovations that you've done based on making your home more accessible for somebody who is disabled, for example. Okay, so it's the home accessibility credit, I believe, is the name. So I'm just going to look it up 2 seconds on the CRA website. So essentially, very simply put, what you can do is, so ramps that you put in there, what's called guardrails as well, that you put in there as well. These are all expenses that would be deductible on the return as a non-refundable tax credit. So these are, of course, supported in the software as well. In UFile, you simply go into the medical expenses section, where you can simply claim those amounts. Okay, so that's very easily done. So I'm just going to look up the form 1 second, just to make sure that I've got the option. So there you go. So it's called Home Accessibility Expenses. That's the credit. The line number is 31285. So this year we know that the CRA has completely changed the line numbers. They've gone 5 digits instead of 3 on the federal side. On the provincial side, they've gone 5 instead of 4. So that's why I'm giving you so many digits. I apologize for that. Not my doing. It's the CRA's doing. Okay. So it's 31285. Okay, is the line number that you can use in order to claim that specific credit. Now, there are, of course, conditions in order to claim that specific amount. Okay, so just go ahead and read the guide directly. But it's usually related to somebody who's disabled and for which you had to do renovations in order to make it more accessible.
Okay, I'd just like to say to our followers, if we missed your question, don't hesitate to re-ask, by the way, because we have, I think, a limited space here to see the questions.
Yes.
Emmy, do you have anybody?
So we have a client here who said that she started this year. She started paying back her HBP.
Her HBP, okay.
Home buyer's plan.
Okay.
Which is it's close to $1,666. She contributed close to $10,000 to go on her first 60 days of her RSPs, and additional amount of the $1,666 towards her HBP.
Yes.
So she wanted to know if she should enter if the fund issue receipts of $11,666, or does she has to enter inside UFile $11,666 in her RSP section in her UFile online?
Okay, so to repeat the question, because Emmy, you don't have a microphone next to you right now. So essentially, you've got a person who's got home buyer's plan repayment to do. Okay, they've contributed quite a bit amount, about $10,000 in the first 60 days, and has another 1,600 and something. The required repayment, I believe, is the 1,100 and something, right? That's the required repayment that the person has. So now the question is, how would we properly input this in UFile in order to stipulate to the software that I want to take that 1,100 and use it as a repayment for my home buyer's plan, right? So that's essentially what the question would be. So the long story short of it, yes, what you would have to do is you have to plug in the RSP section, you're plugging in whatever you see on that receipt, which is 11,167, okay? That'll be the amount. Now, within the same section or around that section, you should have a section called the home buyer's plan repayment. Okay, within that one, you're going to have a field where you will specify the amount that you want to designate as a repayment for your home buyer's plan. So in the second section, you will input the actual amount, which is 1,167. And what UFile will do based on those entries is it'll claim 10,000 as a deduction, as an RSP deduction, and then 1,167 as a repayment for the home buyer's plan. So there's 2 entries. So yes, RSP section, you're entering the full amount, including the home buyer's plan repayment. In the second section, the dedicated home buyer's plan repayment, you enter 1,167.
Good. We have a question from Tainan Lu. She wants to know if, sorry, let's do Tita Maria first. She wants to know what are the big tax changes for this year.
Okay, for this year, there aren't many changes. Okay, really on the return itself, there aren't a lot of changes. So, one change that is coming about that you might notice this year, but that is really related to next year is the Canada Training Credit. That's one that's really coming for 2020. So I'm just going to go to my document here. Sorry, guys. I'm just going to go to it so I could see. We do have, by the way, on our UFile blog, we have an article on all the tax changes that are coming in the return. Okay, so if you go to ufile.ca, you go to the tips and tools section. You simply click on that. You go to the UFile blog, and we have an article on the tax update, which I'm going to directly right now. Okay, that's where I'm going to go see all my changes. So now, some of the changes that we have, I mentioned the Canada Training Credit. This is going to be a new refundable credit on the tax return that will be based on your tuition fees during the year, but this starts in 2020. Now, why do I mention that this year? It's because we have a new limit that you have to create starting in 2019, like an RSP, like a TFSA, in order to be able to claim that credit in 2020. Okay? And now you will notice UFile will compute this amount for you in a new form and will carry forward this new limit for you next year. Now, other changes that have been brought about, home buyers plan. We just mentioned it just now in the previous question. The limit, as the withdrawal limit, will go from $25,000 to $35,000. Okay, that's another change that has been brought about as well. And you also have some important changes on the Canada Workers Benefit, which is simply a new marketing term for the working income tax benefit. Okay, so the government has simply increased the amount that you can claim. This is a refundable credit based on your employment income. If you're just starting off in the job market, for example, let's say you're a teenager and you're starting off in the job market, you get an additional incentive, an additional refund called the Canada Workers Benefit, which is based on your employment income. What the government has done is to increase the amount that you can claim and also increase the thresholds for which you can claim those credits as well.
Okay, there's a client that asked about the carbon tax.
Yes.
Is there a return for that?
Okay, so the carbon tax, there's no return. Okay, so the way it works is that it depends on the province that you're in. Okay, whether you will see a what's called the carbon tax rebate or not. Okay, so it depends essentially on again which provinces you're in. So, basically, let's picture it this way: you have a naughty list right now, and you have a good list. Okay, when it comes to provinces, when it comes to the federal government. Okay, the naughty list are the provinces that have decided to not offer an equivalent carbon tax provincially. Okay, so some of these would be, I believe it's New Brunswick, what's called Saskatchewan is another one. Alberta just became one, although I think now they just made an agreement, and so on. So for those, and Ontario as well. Okay, Ontario is part of the naughty list. Now I say that I'm just joking around here, but that's literally what it is. Because these governments did not enact a provincial equivalent for the carbon tax, okay, then in that case, the federal government is imposing the carbon tax, and the residents of these provinces will get what's called the carbon credit, okay, the carbon rebate in this case. So it's a rebate by simply being a resident of these provinces. The moment you're a resident of the province, you get a certain amount, and it's not income based either. It depends also on whether you are in an urban area or in a rural area, the amount that you're going to get. These amounts are refundable. Okay, so it's a refundable credit. So even if you're not taxable, even if you have no federal tax or provincial tax owing, you will still get the rebate. Okay, you still get a refund back from that rebate. Okay, there's nothing special to do in the software, for example, in UFile. The moment you meet the criteria, which basically means you're a resident of these provinces, you get the rebate. So there's no special return. It's an additional form that gets added, which is Schedule 14, but only for those specific provinces on the naughty list. Okay, that's essentially how it works.
And you should find that section in the interview at the beginning of this software.
Yeah. So, essentially, at the beginning, to choose whether you're in a rural area or an urban area. That's essentially what it is.
We have Matthew Gleiser. He would like to complete a return for a trust.
Okay.
Yes. He said he has only a couple of T3s and T5s slips to be entered. I've done my personal return for many years, but I am unsure how to complete the return for a trust.
Oh, wow. Okay. So that's now we're getting to the complex stuff. I like those kind of questions. Yeah. I like those kind of questions because that's on the professional side. So, well, first things first, we don't have a UFile equivalent for trusts. Okay. We do have the equivalent of our professional product, which we call DT Max, DTMAX. You could Google that, and we sell returns, in small bundles, like for 2 returns or 1 return, pay-per-use kind of thing, for example. Okay. For trust returns, listen, I mean, I just sold you now a professional product, which is DT Max. I would tell you it becomes more complex. Okay, the complexity of return is a lot more because now what you have is an entity, a separate entity that allocates and distributes income to beneficiaries, right? That's essentially how a trust works, okay? The most common ones that we see is testamentary trusts. Somebody passes away, they create an entity to slowly allocate their assets to the beneficiaries, okay? So, I mean, the question was, can he do it, or what was the question exactly?
He's not sure how to go about it, how to do it.
Okay, I would say, listen, the best way, if you want to do it yourself, The best way would be to go to like the general guide when it comes to trusts. There's a T3 guide, as they called. So you simply look up T3 guide on the CRA website. That will explain to you the gist of how to produce a return, okay? How to produce a a trust return. And like I said, we offer a solution for that. You simply Google DT-MAX. DT as one word, max as another word, okay? And we sell per return, okay? But I would recommend that you go to, it's called the T3 guide, look it up, and that will explain to you step by step how to produce that kind of return.
Okay, we have Kellyanne Mathis. I have been using UFile for over 10 years. Thank you, Kelly.
Thank you,
for
Kelly.
your trust.
Thank you.
In UFile.
And
We had a problem with our computer last year and couldn't retrieve the information for a couple of previous years in order to make a change we need to make. It died along with the computer it was on. Does UFile keep or can I get the roots from previous years so I can make this change, or do I have to go to the CRA directly? It has to do with the RSPs from the year before we had the root for. Okay, Kellyanne, were you using the Windows computer? Were you using the Windows software?
Or the online product.
Yeah, exactly.
If it's the online product, the records are there. Okay. If you're using ufile.ca, you have all your past years. They're on the servers they're on our servers right now. But if not, if you don't have a backup of your files with UFile for Windows, then yeah, you would have to likely go to the CRA and get copies of your notice of assessments from the previous year. Okay, that would be, so again, you could do this through My Account. It's very quickly done. Again, My Account CRA, if you want to Google it, that's the quickest way of finding it. So you go to My Account and get your information from there. That would be the quickest way of doing it.
Okay, one tip for our listener here, if you are using Windows, it's always good to have a copy in PDF of your file because we never know. Computers don't last forever. So that's my trick anyways. Okay, Arlene, she asks, which part could I adjust the student's loan tax? My daughter was not able to claim the tax for 2 years already.
Student loans. Okay, so you're talking about, so I'm assuming it's the interest on the student loans that were paid. And the customer basically wants to claim them, right? Prior years as well, basically?
That's what it looks like because she says the daughter was not able to claim for 2 years.
Okay.
She must have low income or something.
Then you can, these are amounts that can be carried forward from one year to the next. If my memory serves me, the student loan carry forward is 5 years. You can carry forward these loans, the loan interest that you were not able to use for 5 years. You simply go ahead and claim them. In UFile, you have an option within the student loan section where you enter the carry forward amount that you have. And the moment you are taxable, UFile will apply them automatically. So yes, you can do that. And I believe the limit is 5 years that you can claim these.
But the interest on the student loan, that's only can be claimed by the student. You can't transfer them to a parent.
No, it's not. Exactly. It's the amount that's not transferable, unfortunately. No, it's only the student can claim those amounts directly on their return.
Okay. So. Okay, I have a question for you.
Yes.
I've seen this over the years. This has been asked over and over. It's a common question. We have parents that file for their child or they include their child on their return. They're 16, 17 years old, and they have summer jobs. So either as a lifeguard, sometimes they're a referee for soccer. So most of them either have a T4 or a T4A. And the question keeps arising. Can I deduct their swimming trunks? Can I deduct the cleats? Can I deduct any equipment they use?
Okay, so that would be considered uniforms, right? I mean that's essentially what we're talking about there. So there's good and bad news depending on what type of income you're talking about. If it's employment income, unfortunately, no can do. Okay, this is not part of what the government allows as employment expenses. Unlike the first question that we got, where you had a home office and they can claim those expenses. Unfortunately, even if you were to get that special form, which is the T2200, okay, so 2200. Unfortunately, they're not deductible. Okay, the government does not allow for it. Now, if you're self-employed, That's different now. Now you're a business, you're self-employed. These are expenses that would be deductible off of your business income at that point. So when you produce your specific business form, which would be the T2125, okay, that would be the form which UFile supports in all versions. I had to plug that.
Of course.
UFile supports it in all versions, whether it's a UFile 4, UFile 12, it's supported in all of them. In that case, they become deductible, and you can deduct them as essentially, supplies that you need in the course of a business. Okay, so in that case, you can do that.
Okay, we have another question from Sheila Willis. She asks, to claim the Canada caregiver amount for a parent not living with us,
Yes.
do I have to include the parent as a dependent when I complete my own tax return, even if I won't be filing that parent's return? Okay.
This one is tricky, Sheila. The reason being that for the Canada caregiver amount, normally what the rules stipulate is that this person has to be residing with you. Okay, it's not a credit that you can claim for somebody who's either just visiting you or simply does not reside with you on a regular basis. Okay, the other criteria for the caregiver amount is that you have to have also what the government considers an infirmity. Okay, so something, a physical ailment that doesn't allow you to be 100%. Okay, in this case, you would need a doctor's note in order to be able to claim that. Now again, check with the CRA, double check with them to see, but our understanding of it, at least my understanding of it, is that for the caregiver amount, the person has to reside with you. Now, let's say you call the CRA and they tell you, sure, you can do that. First things first, pro tip that I'm going to give you guys today, anytime you call the CRA for tax advice, please ask them for a reference. In other words, what I mean by reference is, okay, I'm telling you right now that the person has to be living with you. Okay, that's my answer. I'm basing this on the general guide. Okay, I'm basing this on a document that the government produces. Okay, if the government agent tells you otherwise, ask them what the reference is. What document are they basing this advice for you? Ask for the specific form. Okay, ask for the specific document, a guide, whatever it is. Okay, now assume for a second now that they say yes, you can. In that case, yes, you're absolutely right. In UFile, you would have to create this person as a family member, as a dependent linked to you. Therefore, the program will know to claim this amount automatically for you. Okay? But again, I would double check the guide and check with the CRA to see whether you can claim the caregiver amount for somebody who is not residing with you. My understanding is, unfortunately, you cannot. Okay? But I would double check that just in case.
Okay. Another listener is asking, should teenagers file a return when they get a job?
This is an answer this is a question I get a lot. Yes. What was my answer again? Yes. Yes, absolutely. There's a reason for this. The specific reason is if they have a job, they pay tax on that job. We all pay payroll taxes to our jobs, right? We all have withholdings at source. So our withholdings at source are CPP, EI, and federal tax, which includes our provincial component as well. If you want to get that tax reimbursed, okay, you have to file a tax return. That's the whole purpose of a tax return. A tax return is a reconciliation statement. It's basically you are determining whether you pay too much tax during the year or too little tax during the year. That's what you're doing with your tax return. So it is very likely that the teenager has paid tax at source for that job. It is also very likely that the teenager is not taxable as per the tax return. Okay, they'll have income that's less what the government calls the basic personal amount, which is $12,000. So in that case, they get their full payroll tax refunded to them. Not only that, I mentioned earlier in the changes about the Canada Workers Benefit, which is a refundable tax credit that's on your return based on your job, based on your employment income. These teenagers specifically fall right into that Canada Workers Benefit, okay? And they can get even additional amounts depending if they meet all the criteria. So what was my answer again? Yes! File a return. Not only that, hold on, I forgot. They could also start their eligibility for the GST credit as well. If they're 17, they have to file their tax return in 17 so that when they turn 19, the first quarter that they turn 19, they can start collecting their quarterly GST checks as well. So yes. Did I say that again? Did I mention that? All right.
I didn't hear you, Jerry.
Next question.
Okay. We have Catherine that's asking, can you claim scrubs if you're a licensed practitioner nurse?
Again, a nurse would likely not be self-employed. There would be an employee. So unfortunately, at least to my knowledge, the answer would be no. Okay, because again, scrubs, hold on. Scrubs will be supplies. Hold on. No, I'm wrong. I'm not the uniforms. I'm sorry. Scrubs, it's possible, but you would have to get the special form that I mentioned before, which is T2200. If you're paying these out of pocket and your employer confirms that they're not reimbursing you for those scrubs, then it's possible in that case to consider them as supplies. But you have to double check with the CRA and the specific guide. So employment expenses guide is what you would look for on the CRA website.
Okay, actually, a lady is also asking, can she claim her child's school uniform?
Her child's school uniforms. The answer would likely be no. Because you would have to, remember, this would be an expense under what income, right?
Exactly.
Is it employment income? Are they self-employed? Likely they're not. If they're employment income, definitely not. As we mentioned before, uniforms don't count. Okay, they're not deductible as per the law when it comes to employment expenses. So the answer is no, usually in this case. In tuition, definitely not, because tuition only relates to post-secondary, which means university, right? So the answer is no.
Okay, we have a question from Tony Zamed. He said he called the CRA twice and received different answers. Okay. He has a series of GICs with different maturity dates.
Okay.
If you have a 36-month GIC maturing in 2021, do you claim interest earned each year, or you can wait until the GIC matures and claim the entire earned interest in 2021?
Okay. It's a very good question, Tony. Very good question, because that's a confusing one. Because now you're getting into accounting principles as well.
Exactly.
Are we based on accrual or are we based on a cash basis? In this case, it's cash, which means whatever you gained, whether you took the money or not, if the interest was earned in the year, you have to declare it in that year, whether you have actually collected the cash or not. So the answer is no, you don't wait till the maturity to declare the income. You have to declare the income when it was gained. Okay, regardless of whether you've actually taken it as cash or not. Okay, so you have a 36-month, that means 3 years in this case. So every year, you're supposed to have an interest income to declare for that GIC on your tax return every single year.
But nowadays, most banks will issue a T5 slip or a T3 slip, right?
Yeah, you're supposed to have one.
You're
yes.
supposed to have one.
You're supposed to have one. If not, you're still required to declare. It doesn't matter. Even if the financial institution has made a mistake of not sending you that T5, you still have to declare that income on your tax return. Absolutely.
Actually, we have another good question from Catherine.
Yes.
Can you claim childcare expenses for a preschooler if the mother is on maternity leave?
Okay, so can you claim childcare expense for a preschooler if the mother is on maternity leave? Okay, the answer depends on the province. In Quebec, the answer would be yes, if you are in Quebec for the provincial side. On the federal side, unfortunately, it's not the case. Because in this case, what happens is, remember the concept of childcare expenses, the deduction in this case, is that it allows you to go back to work. It allows you to basically work. You need the childcare expense. You're incurring the childcare expenses to work. If you're on maternity leave, you're not working during that time. Okay, and the way the actual technical calculation works is that you need at the very least some employment income in the year in order to claim childcare expenses. So it's possible that you will still be able to claim your childcare expenses if you collected maternity leave at one point in the year. So for example, you worked at a portion of the year and then you collect maternity leave, then you will get it. But if the whole year, all you collected was maternity leave for the calendar year, unfortunately, no can do. No childcare expenses are deductible in that case. Because again, and as long as you're the lower income spouse as well, that's the other catch as well. Remember that on the federal side, it's the lower income spouse that always is required to claim the childcare expenses. And in this case, if the lower income spouse has the maternity leave for the whole year, unfortunately, no can do. Unless you need some employment income at one point in the year to be able to claim childcare expenses. That's the criteria.
Okay, we have a question from Zaid.
Yeah.
I will be answering your question offline because the CVITP program is a Windows version and you're talking about to use the online version. So it's two different platforms, all right? So I'll get back to you a little bit later on that. Okay, Diane Stewart Masson.
Yeah.
I have a T5008 slip and have entered all of the information except date of settlement and date of acquisition, as it wasn't included on the slip. Do these dates have to be included on the tax return?
Okay, Diane, the answer is no. On the form itself, which is Schedule 3, which is where you're going to declare, in this case, any capital, because these are capital gain slips. I mean, that's essentially what they are. They're transaction slips for capital gains transactions, okay? So in this case, the answer is no. On the form itself, and when you're going to transmit through NetFile, that information does not transmit to the CRA. Now, the software is going to require you likely to enter, I believe it's the date of acquisition. I'm just going to check Schedule 3 now while I'm here. So let me just have a look at it in 2 seconds. So you've got the year of acquisition, exactly. So it's the year of acquisition that will ask, but again, not a requirement, okay? But when you're going to transmit the return electronically through NetFile, it's not an information that transmits to the CRA. So the answer is no. You're not required in this case.
Okay. Sharon has asked if they have removed the child activity fee.
Okay, the answer is, and here comes my cheesy joke of the day. Every answer to a tax question is, it depends. All right, just remember that, guys, okay? The answer to every single tax question, I know you're laughing politely. I know. I'm sorry. I'm working through this, okay? I will try to stop the cheesy jokes. But the answer in this case is, on the federal side, yes. Unfortunately, child activities was removed by the federal government because what they did was up the Canada Child Benefit, which is the monthly benefit, the monthly tax-free benefit that is received for children, okay? So because of that, of course, to fund that increase of the Canada Child Benefit, well, we have to grab money from somewhere else, right? So at that point, the government scrapped that program. However, it's not the case for every province. There are some provinces that still offer provincially. I know for a fact Quebec offers that here. And there's some other provinces as well. I can't think of them all off the top of my head. But just, what's called, check within UFile if child activities is eligible in your province. UFile will include that section automatically, okay, when you are when you're entering the information for your child. Okay, so you don't need to worry about it. UFile knows which provinces are eligible and which ones are not, and you'll simply see the section appear in the child's file in UFile.
I know some provinces offer that credit for seniors.
Certain ones do, yes. Certain ones do. Again, Quebec is one example of that. For seniors activities as well. I believe Ontario, don't quote me on it, might as well. But just, again, check. Again, UFile will have these sections appear automatically if on the provincial side you're eligible for this.
Only on the provincial, not the federal, correct?
Mm-hmm. Exactly.
Okay.
All right, so are we at the... So we don't have any questions,
okay.
All right.
Questions that come up all the time, I've seen many articles in the past couple of weeks. People don't know the difference or cannot differentiate between a RRSP and a TFSA.
Okay. So let's do a little primer.
The main
differences. Let's do a little primer, and hopefully I don't get too wordy on this, because there are quite a few differences, but I'll try to synthesize them as much as I can. So RRSP is based on what we will call pre-tax dollars, which means that any contribution I make to my RRSP, I can deduct off of my taxable income. Okay, that's number one. Okay, which means that's what they're called pre-tax dollars. The government will not charge any tax on that income that you gain because you decided to contribute to your RRSP. A TFSA are post-tax dollars, which means that whatever contribution I make to my TFSA, unfortunately, I cannot deduct that contribution off of my taxable income. So at the contribution level, I'm reducing my tax payable with my RRSP. I'm not reducing my tax payable on my TFSA. So far we're thinking, all right, yay RRSP. That's where I'm going. But it's a little bit more complicated than that, okay? Now, what happens with the income that's in your RRSP and your TFSA? These work the same way, which means that any income that you gain while they are in the accounts, they are tax shielded. They're tax deferred. In other words, they're shielded from being taxed. No tax gets charged on that income while they are in those accounts. Now, what happens when I withdraw? This is where now the big difference comes in. When I withdraw, RRSP, taxable income now. Okay? And when I reach the age of 71, I'm required to pull out at a certain percentage for that income. TFSA, completely tax-free. Hence the name tax-free savings account. So whatever I withdraw from my TFSA, I collect it tax-free altogether. So of course there's pros and cons, right, between them. Because my RSP, I get that instant gratification of my tax being reduced, but later on I'll have to pay a tax, I'll have a tax bill later on that income. But again, between my contribution and when I pull out, that's a lot of years usually between those years. And what's great about it is that all that income starts accumulating tax-free in the meantime. So if you are at a higher income, RSP, if you're in the second, third, or fourth, or even the fifth tax bracket, you are now, it is more advantageous to go with an RSP. If you're in the lower income bracket, especially the first income bracket, you're much better off staying with the TFSA. Now, the other thing that you have to check is what's your time frame? When do you need this income? Are you saving to buy a car, or are you saving for your retirement? RSP becomes more beneficial in that case when you're saving for retirement. If you're saving up for a car purchase, then a TFSA becomes a lot more advantageous. So, just some of the differences there between them. And we have a really great article, by the way, on our UFile blog, things to consider before you contribute in one account or the other. So again, it's ufile.ca, go to tips and tricks, and you'll see the UFile blog, tips and tools, and you'll see the UFile blog option.
Okay, we have a question from Pat Bunton Wahlberg. I hope I pronounced it correctly. Okay, can I still claim my adult children's university tuitions? They're 28 and 30 years old, but they do not live at home.
The answer is yes. These amounts will be transferable to you. Your child has to sign off on their actual slip, which is the T2202, as we call it, actively. So yes, these tuition fees are transferable as long as your child does not need them to reduce their tax payable to zero. Okay? The first thing that your children have to do is use up their tuition to reduce their federal tax to zero. If there's an excess amount, then that amount becomes transferable to you, or your child can keep them and carry them forward to the following year.
Okay, we have a question from Lori Olson. What about prescription costs for senior? The expense is so high and no farmer care plan in sight. Are these deductible?
Okay, so Lori, you're absolutely right. The costs are very, very high when it comes to prescriptions. Absolutely right on that. The answer, fortunately, is yes. Okay, and prescription drugs, these fall under medical expenses. So medical expenses are a non-refundable tax credit. So any prescriptions that you have for medical expenses, you become deductible in a sense, but they're actually a credit. So you grab those expenses, you claim them as medical expenses, and they get reduced by 3% of your net income. Okay? And whatever's left over, you claim as a credit on your tax return, and this is and what the government allows you to claim is 15% of that net amount, which is expenses minus 3% of your net income. Whatever the result is, you're claiming at 15%. So yes, they are deductible, fortunately.
We have a question from Matthew. Can you claim the cost of employees' paid portion of benefits? If so, can you claim medical costs? So he probably has a group insurance at work.
Yes.
So
okay, so the answer is yes. That again falls in the same category as the one before for prescription drugs. So whatever you're paying for insurance with your employer, okay, these are a deductible medical expense. Okay, but again, deductible is not the right term. They're eligible for the medical expense credit. So whatever you're paying out of pocket for that insurance, you claim it as a medical expense exactly the same way as your prescription drugs, whatever you pay for your prescriptions. Now, these amounts, in order to find those amounts, there's two places. Either you're going to find a specific box on your T4 slip, which is box 85, if your employer has done them right. If your employer has done your T4s right.
They don't have to put it there.
They don't have to, unfortunately, but they should. They should put them there. So look for box 85 on your T4 slips. If you don't see them, then you have to grab your last pay stub with your employer and look up the accumulated amount that you have as of December 31st. And that's the amount you grab and you claim in the medical expense credit.
Okay, we have a question from Anna. This is more on UFile Online. She's talking about, I came across this new question on UFile Online. Report on tax savings between spouses. And now can't seem to find it. Did it disappear from the interview?
I don't believe it disappeared. What triggers that form is a transfer between spouses. So essentially what the report of tax savings does in the software is that it explains to you, basically, let's understand the concept first. In the Income Tax Act, you are allowed to transfer certain credits and certain amounts between you and your spouse. So examples of these are medical expenses, donations, and pension income. Okay? So all these amounts are transferable between spouses. Now, the moment you perform these transfers, there's always going to be one spouse that will pay a little bit more tax in order for the other spouse to claim bigger tax savings. Therefore, your combined result on your return will be better by doing this transfer. But remember that one spouse now is kind of, sacrificing themselves for the team here a little bit, okay? Because they're going to have to pay a little bit more tax.
It's a teamwork.
It's teamwork, but still, it would be nice to know what that sacrifice is, right? I mean, am I right here? Please tell me in the comments if I'm right or not, okay? Please write it in. So in that scenario, the tax savings, what that form will do is that it'll tell you what one spouse should compensate the other in order for the family as a whole to have a better result. Okay, that's what the tax savings does. That form will generate automatically the moment there's a transfer. If there's no transfer, then the form disappears. So check your file again and see if whether maybe accidentally you disable the transfer between you and your spouse, okay, or simply things changed on your return and now there's nothing transferable anymore between you and your spouse. And we're talking again, donations, childcare, medical expenses, and pension income. Those are the 4 things that would usually trigger that form.
Do you sacrifice yourself for your wife?
Next question.
Okay, we have a question from Tita. Her sister is an employee, but also sells Tupperware on the side, and she gets a T4A.
T4A.
Can she claim expenses? And is there a minimum income before you can claim expenses?
Okay, so first things first. Well, congratulations on Tupperware. They're great products, by the way. They're really, really nice.
They're still out there.
My God, I really love them, actually. Yeah, I've got some from like 20 years old, and they're still amazing. They're still amazing. So, sorry, okay, shameless plug on Tupperware. Let's get back to tax. So, on Tupperware, well, now you're self-employed. The moment you get a T4A, that essentially means you're self-employed, okay? Because you're running a business. You're selling a product. That means you're running a business. So that's what the T4A is about, okay? Is that you're getting your commissions out of the Tupperware sales. So the answer is yes. There's no minimum income in order to deduct those expenses. The moment you get that T4A, you're considered self-employed, and now you can deduct expenses like anybody else who's self-employed. No difference. You are a salesperson. You're selling products. So I'm sure in this case Tupperware, you're buying the gear to be able to sell. So yes, the answer is yes, and no minimums are required.
Okay, for somebody who's self-employed, they have an office at home. They use their cell phone. They use the internet. Can they deduct those expenses? And what percentage can they deduct?
Okay, so the answer is yes, just like the first question that we got to before, right? Which was the employment expenses. Same concept. So if you have a dedicated area in your office, okay, a dedicated purely for your business, then you have to grab whatever that area represents vis-a-vis the total area of your house. So the example I gave before was 10%, let's say, okay? So and now remember, this area has to be dedicated for the business. It can't just be your bedroom and then, the laptop that you use on your bed, all right, to be able to do things. That doesn't work, okay? You have to have a dedicated area in your house that is related to your business, okay? Now, once you've determined that dedicated area, you determine at this point what the area represents, and then you take the percentage. So let's say 10%. Let's assume right now that my home office is 10% of my house. That means that what the examples you gave me, internet, phone, whichever, and other examples, heating, property taxes, so on. I can now deduct 10% of the value of those expenses as a home office expense in this case.
If I purchase a cell phone and a number dedicated only for my business, would that become 100% deductible?
Then yes. If I'm using, so for example, let's say I rent an office. I rent office space. Now all these expenses become 100% deductible because I'm purely using them for the business. But again, they have to be dedicated. It can't just be your regular cell phone and you're just using it part-time for your business. That doesn't work. Then you have to prorate at that point.
Okay, we have a question from Diane. No, sorry, let's go with Kathy first. Are property taxes deductible?
Again, what was the answer to every tax question?
It depends.
It depends. All right, so that's always the answer to the question. Do you have a rental property? Then the answer is yes. For your personal home, the answer is no. That's essentially how it works. Okay, do you have a home office? Then the answer is yes on a prorated level. If you don't have a home office and you're self-employed, then the answer is no. So it all depends. Remember, the golden rule when it comes to the deductible expenses is, are these expenses incurred in order for me to make money, in order for me to make income? If it's not, then they're not deductible. So obviously my personal home, I'm not making income off that personal home. So no, but if I have a rental property, then the answer is yes.
Okay, now we have two questions regarding the T4 slip box 85. Okay, Diane Stewart Masson says she went and checked her box 85 and it's not there.
Okay.
Is it tax benefit on the pay stub?
Well, the answer is yes.
Yeah.
What you would have is you have a withholding. Remember that your employer withheld at source every single pay the amount of insurance that you are liable for, okay? That you have to pay out of pocket. So there should be an item somewhere in your pay stub that indicates the amount that you're paying for insurance. Now, let me preface this by saying we're talking about medical insurance. So we're talking about medical and dental. We don't include any life insurance that your employer might be offering as well. That's not deductible, okay? Purely medical and dental is deductible. So there should be somewhere on your pay stub where these amounts are deductible. Now I'm just gonna make a little comeback about the property taxes. So now, what I mean by property taxes, I'm talking about the amount that you want to deduct directly off your return. There are some provinces that offer credits based on your property taxes. So that you have to check. I know, for example, Ontario has a trillion benefit, which you can deduct to a certain level. But these are credits. They're not purely deductible amounts, okay? The only times you can deduct property tax directly off your income is if you are using it in order to gain income, okay? So I just wanted to specify that.
Okay, Ada had also asked about she checked her T4, the box 85 is not there. Mm-hmm. She's how do I prove I can still claim it on my income tax? Okay,
the way you prove it is you keep a copy of your pay stub, and if the government later on checks your return and asks you for the proof, you provide them with your pay stub. It's as simple as that. You are absolutely entitled to that amount. Guys, let me make sure that you guys are claiming these amounts because they're important amounts. Let's not kid ourselves. They're in the thousands usually, these amounts. And these are eligible for the medical expense credit. So don't hesitate just because you don't have an official T4, just because your box 85 is not there, don't hesitate to claim those credits. Your pay stub is proof. The CRA cannot contest you if you have a pay stub with that amount on it. They can't.
That's, of course, if you are paying, if you are taking deductions off your pay.
Yeah, which is the case usually. It's usually the case how these work.
Okay, we have a couple of minutes left.
So
why don't you talk a little bit about RESPs?
Okay, so RESPs, and let me try to time myself here perfectly.
Yes.
So RESPs essentially are a means by which you can save for the future education, post-secondary education of your child. Long story short, I cannot recommend these enough, okay? Reason being that, unfortunately, they're not deductible on your tax return, the contributions, like the TFSA. But the difference is you are entitled to grants when you make those contributions. So what happens is if you contribute up to $2,500 per year, you can get upwards of 20% kicked back to you in those accounts by the federal government, and some provinces offer an additional kickback on those amounts. I know that in Quebec, there's an extra 10%, and in other provinces as well, there's extra amounts. So from there, now any income that's gained in there is tax sheltered, okay, is tax sheltered. And then once you withdraw, it is your child that withdraws the amounts. Your original contributions are tax-free, okay? Your original contributions are tax-free. And then your child only gets taxed on the gains. And it's your child that gets taxed while they're studying, which means the tax rate will be basically very minimal, very, very minimal. So I can't recommend those enough.
All right. Thank you for... Okay, actually we have another question. Tony, Why can't we claim 338 dependent?
Oh, let me see. Okay, sorry. I thought it was
in Ottawa?
Okay.
Is that the line 338?
Yes. Yeah.
Okay.
Sorry. 338. Okay, I'm not sure, Tony. I'm not sure about your question there. I'm not sure.
Tony, why don't you send me a message afterwards and we will check with you for that. Okay, so thank you very much, everybody. Some of you, I will contact the winners because we didn't say at the beginning, but we will be drawing 3 to 4 UFile Online family returns. So I will notify you via messengers when the ones who win.
I think I understand.
Else?
No, I think I understand, Tony.